Hello and welcome to Beyond Markets, where we bring you up to speed on development outcomes in Africa. I'm Kenneth Igbomor, and on today's show, we're looking at the impact of the COVID-19 pandemic on Africa's banking sector and find out how lenders are staying ahead. You can join the conversations, use our online platforms on social media. The hashtag is at Beyond Markets. You can also hit me up at Kenneth Igbomor. Now, Moody's changed its outlook on Nigeria's banking system to negative from stable, and it says banks will face weakening loan liquidity and foreign currency liquidity. Now, one of Nigeria's top lenders, Zenith Bank, has reported its Q1 earnings, and we'll be speaking to the GMD and CEO, Ebenezer Onyeagwu, who is the CEO of Zenith Bank. Thank you so much for joining me on the show today, Ebenezer. And I would first like to start off with you speaking on how you see this COVID-19 impacting the banking sector so far in Nigeria. We see that the government is trying to ease the COVID-19 lockdowns, and I'd like to know how you see that would play out in a couple of days.
Thank you very much, Kenneth, for having me on. First and foremost, COVID-19 is not about the banking sector alone. It is a pandemic that affects the entire globe and the entire sector in every economy, in every region. So it is not something that is targeted or particularly related to banking alone. It affects every facet of the economy. Therefore, it's a matter that has created very unprecedented outcome. The word unprecedented, complexity, uncertainty have never found a better expression than now. So it's speaking specifically in terms of how it affects banking. In a situation where you have a lockdown of the economy, if you lock down all the economic agents, and with human being, individual being the most active aspect of the economic agent, being primarily locked down, there is no way business volume will not be impacted. So business volume will be impacted as far as banking is concerned. Again, for Nigeria, in terms of specifics, one of the immediate effects of the pandemic is the fact that oil price has declined. Oil price has collapsed, I would say. And that has had a direct impact in terms of our revenue target. Government has had cost to reset the budget benchmark from about $55 to $30 per barrel oil. But even at that, demand for crude now is completely not there. The reason is quite simple. If you have a general situation where economies all over the world are not operating as usual, where will consumption of energy come from? Airlines are not flying. Who will consume aviation fuel? So we have a situation where the pandemic is affecting government revenue and by extension affecting banking. In terms of banking, the drop in the price of crude is also affecting directly the exposure that banks have created in the oil and gas sector. Revenues are challenged now, no doubt. And you have a situation where revenues are challenged. The obvious next step will be for you to restructure and also engage in tenor elongation. But the thing we have here is that nobody has an idea of when this will end. The entire focus now is on flattening the curve, making sure that the spread of pandemic is halted and contained. But then until a complete remedy is found by way of vaccine, where we now know that, yes, it can be treated, we know that there's a vaccine to deal with it, I think we are in for a very, very challenging moment. So in this moment too, as far as banking is concerned, we're also going to experience the fact that we don't expect a situation where there will be growth booked. Growth loan will be challenged. What banks doing now is different sectors of the economy and how the COVID impacts them and restructuring the loan book. The central bank has even given a dispensation to this effect, asking banks to come up with the various proposals they have for the restructuring of the loan book. We have equally seen on the, if you like, the positive side, the fact that there is a lockdown has seen this moving in a very, very drastic manner to the electronic channels. We have seen a tremendous and supersonic increase in the volume of business going through the electronic channels. Customers who before were not really interested in digital channels are now showing very, very active interest. So we are seeing very phenomenal growth in terms of the adaptation to digital channels. And another thing is that the pandemic has transformed the way we live, the way we do things. Right now, we are meeting, and everybody is resort to having meetings on digital channel. Either you are using Zoom, you are using Microsoft, the various platforms for meeting. So the pandemic has completely transformed the way we do things. Is now redirecting our energy to more creative ways of load and staying very relevant in the moment. So for us, we see it as an opportunity for us to really deploy our creative talent in enhancing our digital capabilities so that we'll be able to really contend with the issues until a vaccine is found.
All right, now let's come to the earnings now and then look at how it played out for you in the first quarter. We're looking at your PAT is up 0.6%. We're seeing gross earnings up 6%. Can you talk us through what's played out there in the bottom line of your report?
Well, the earning came in the way it did. First and foremost is to bear in mind that Q1 is usually a slow period because people take a little more time to return to business, especially the SME and the owner-managed businesses. Immediately after the Christmas and the end of year holidays, take their time to return to business. So that has an impact in slowing down Q1. Q1 too, we have also witnessed a very drastic drop in the yields. So that has impacted the earnings as well. And the last month of Q1, March, witnessed the emergence of the pandemic in Africa and albeit in Nigeria. And we've seen the central bank in one of the initial measures they initiated was to bring about that led to the drop in the margins charge or margins earned on intervention loan availed by the central bank. That has also has its own impact in reducing earnings. So the earnings in Q1, I would say, came in strongly on account of the fact that we increased the volume of business on electronic channel. We've seen our retail banking, especially our agency banking, picking up steam and momentum. So what you see is a reflection of the fact that incremental business has come in on the retail channels, and we have also had to contend with the very declining yield environment.
All right, then, still on the earnings, though, I'd like to speak on to what played out in your net interest income. I see that is down 5% as well, but your net interest income is down 5%, but I also see that your non-interest income is up 43%.
Yes, non-interest income up from 3%. Under the net interest, the non-interest income, you have a whole range of activities coming in there. All our fee activities are aggregated there. Our trading, bonds trading fees are aggregated there. So it's a combination of various income-related activities that we have. Then in terms of interest income going down, interest income went down because within Q1, we saw rates go down dramatically. And average lending rates for the prime customers was in single digit. So that affected the interest income. It was an environment where, recall that we've also seen the impact of the bifurcation of the trading of T-bill, of OMO bills, which also prevented us from taking active interest or participation in the OMO market. So what you see there is a reflection of the environment in which we operated in Q1.
All right, now still on this, one sector I'll look to come is I like to look at is your NPLs. I see that is also up 7%, and I'd like you to speak to that one and also try and chip in your thoughts on the exposure of banks to the oil and gas sector, like you rightly mentioned earlier.
Well, the NPL going up is a reflection of the fact that the loan book has gone up as well. If you look at it, what you have is the effect of the provision for the collective impairment. That's basically what accounted for the increase in the NPL. For the oil and gas sector, I would say that what you see there is that it's a no-brainer. The loans in that sector will have to be restructured. And restructuring it now will mean giving longer tenor. So if you had a loan that you had a tenor of about 5 years, expect to see tenors as long as 7, 8 years, as the case may be. However, we also have some of those oil and gas exposure that have hedges. For those who have hedges, of course, they will not be impacted. But it depends on the duration of the hedge. If you have a longer term hedge, it means that your benefit will also be there until the oil price picks up.
All right, then, Ebenezer, I need to hold that thought for a second. We'll go to a quick break now, and then when we return, we'll definitely continue our conversation on how COVID-19 is impacting the banks in Nigeria and how you plan to stay ahead. Welcome back to Beyond Markets. Today joining us, Ebenezer Onyeagwu, the GMD and CEO of Zenith Bank, is our guest today, and we're talking about COVID-19 and the impact of the banks and how banks plan to stay ahead. Ebenezer, thank you so much for your time on the show today, sir. And picking up from where we left off, we're talking about the exposure of banks to the oil and gas sector. So Moody's says the bank's exposure to the oil and gas sector industry is substantial, at around 27% of total loans at the end of 2019, making the system susceptible to the price of oil, the oil price slump. I'd like you to speak to this and what Zenith Bank is doing on your side in regards to the exposure to the banking, to the oil and gas sector.
Well, Moody's assessment is right in terms of the fact that the exposure is significant. But what we need to understand is, I don't know what other banks have done. Since 2014-15, rising from the commodity crash, we have not increased our exposure in oil and gas. And what you see accounting for the increase is the translation effect of the adjustment of the foreign exchange, rate. Because these loans are predominantly denominated in dollars, when you see exchange rate move, the size of the portfolio move, even when in absolute terms, you have not increased the size of the loan. So that's what you have there. In an environment where risk is elevated, what do you expect to happen? Risk premium will increase. And risk premium increasing is enough for analysts and rating agencies like Moody's to express the kind of opinion they're expressing. But the fact is that this is a global issue. And when you have this kind of scenario happen, what do you do? In this kind of scenario, for us, the watchword is caution. Don't increase exposure. Watch out. Make sure that you align the repayment in line with what the cash flow can take. And again, for some of the loans for us, we proactively had hedges. We have hedges that will last for the next 1 year. We have hedges that will last till maybe another 6 months. So for those assets that are covered by hedges, I would say pretty much there's nothing to worry about. But it is only for those loans that are uncovered that will now be open to the vagaries of the current market situation. But what do I envisage going forward? I don't see any appetite for an incremental growth in terms of oil and gas sector. However, price is depressed, demand is where it is. It doesn't really mean that oil has become worthless. It is about the fact that the whole global economy is on lockdown. When it's on lockdown, energy consumption is low. Without energy consumption, where do you get demand from? So that practically is the whole, which for me, the primary thing that everybody should be focusing on, which is what I would like to say, what will be for the greater good of all, will be how quick first flatten the curve. Once we flatten the curve and we can have return of activities, maybe at the local levels, state and country level, then the scientists, the medical team, if they can help develop the vaccine that will enable us bring an end to this pandemic, until that is done, there won't be any clear-cut mitigation or a clear-cut move to deal with this problem. All we need to do is, for us in Zenith, is to identify with all the stakeholders. That is why in Zenith, the CBN-led coalition against COVID-19, short name COVID, Zenith is a very active participant. We contributed ₦1 billion to that pool to help fight the pandemic and also help provide palliative to the most vulnerable in the society. So now it's about a collective effort to deal with a common problem. There's no one institution that can solve it on its own. And there's no one country that can deal with this problem on its own, because if we say we flatten the curve in Nigeria, what happens to other countries where we have trading partners? If those countries don't also flatten, if the problems are not solved, it means as far as trade is concerned, global trade is concerned, it will impact us. Look at where we are now. Cross-border travel is completely zero. With cross-border travel being zero, airlines are not operating. Airlines are not operating. Entertainment industry, the tourism sector, they are all impacted. And if you have all these impacted, aggregately, it will also impact the performance of banks in terms of volume, in terms of profitability. So the key thing for us now is risk mitigation and minimization. And mark you, another aspect is that COVID-19 is not all that negative.
Ebenezer, it's a good thing you talked on trade there, because it's a quite important part that I also wanted to focus on. Because we're looking at see this play out in the fact that it has delayed the Continental Free Trade Agreement that has been in the works for quite a while now, and everybody was looking forward to. So now that has been delayed. Now, I'd like you to speak to this impact as well and how you see things going.
Well, obviously, deferring the commencement of the African Continental Free Trade Zone is a no-brainer until we have a solution. Human interaction, human traffic cannot flow like it used to do before. And where you don't have human traffic and human flows moving as actively as before, there's no way you can have an effective logistics. So without human interaction, without logistics, you can't do trade. So without cross-border movement, trade will suffer. So it makes sense that we focus on primary issue now, which is about flattening the curve and hoping that pretty soon the scientists will be able to find the curve, God willing. So until that is done, it looks like I said earlier, the word uncertainty, volatility, and complexity, they've never found a better expression than where we are now.
All right, Ebenezer, I'm looking at your report here, and I see that you said Zenith Bank expects a moderate impact on the bank's financial position and that the bank remains resilient to the shocks and other adverse impacts of COVID-19. I'd like you to speak on two things first. One, on how you see this play out with regards to your asset quality, and then also the cost of funds.
Well, for asset quality, like I said, in a situation where you have an obligor whose revenue is challenged, is complete. I mean, the obvious thing to do is to restructure. So we are going to see a situation where there will be a restructuring. The first thing will be to identify sectors that are impacted by the COVID. And for those sectors, the primary thing we are doing is to pay attention to them and restructure them for a longer tenure. There are still some sectors, even in the midst of this COVID, that are doing well. Here we are talking about those who are into the FMCGs. Within this period, they have had incremental growth in their sales. So for such sectors, we don't see any direct impact on COVID. So it's going to be treated on a sectorial basis and also on obligor basis. So that's pretty much what we are going to do to ensure that the asset quality is preserved. Of course, within this period, you don't expect new risk acquisition. While we work on balancing the loan book, we'll be very, very cautious. And in our usual conservative manner, we will continue to choose and pick what kind of transaction that we can do even in this COVID era.
All right, Ebenezer, I'd like you to look at the operating environment in Nigeria now. It's quite a lot you've talked about so far since our conversation here, but I'd like you to speak to that the operating environment that we're going to be playing, especially in the medium to near term, and talk about it, because the Moody's, for example, says that the Nigerian banking system is highly dollarized and it puts pressure on both assets and liabilities, and in the event of a possible naira devaluation. I would like to get your thoughts on that as well.
Well, what I know is that the environment we are in now wasn't the same environment we operated in last year. There's been a dramatic shift. There is massive disruption. And COVID is not all negative. COVID also has its own positive side. and here is the adoption of digital channels. We have seen incremental business volume coming through digital channels. We have seen an acceleration in terms of the retail banking and financial inclusion agenda. Customers and individuals who didn't show interest before in adopting digital channels are now putting banks under pressure for them to be onboarded. So incremental business is coming up on the digital platform. Where in terms of the books of Nigerian banks being dollarized, yes, it wasn't as dollarized as it was, say, 10, 15 years ago, or 20 years ago. Of course, where you have such foreign currency component in your balance sheet, whenever there is a shift in the exchange rate, it's going to have direct impact in terms of the asset quality. So the most important thing now is to ascertain whether such assets, what's the underlying cash flow. If the underlying cash flow is dollar, then pretty much once the economy returns to normal, you are sure that your repayment will come. The bigger danger is where you have learned, you have created a dollar risk asset against a naira cash flow. That is when you pretty much suffer a lot more. But however, about 5 years ago, the Central Bank of Nigeria came up with a regulation where banks were not allowed to create dollar loans unless the obligor has underlying dollar cash flow. So that leaves us pretty much to areas such as the trade finance. For the trade finance too, the positive side is that about 4 or 5 years ago, CBN created the non-deliverable forward. So what we have been doing is that for every LC we open, while waiting for the LCs to be covered, we ensure that our customers buy the non-deliverable forward to hedge against the price risk. So I will say in terms of that's the aspect that Moody's didn't have. Moody's missed that. Moody's didn't create a distinction between trade exposure and outright dollar exposure. So in the trade exposure, unless an institution did not back it up with NDF, then you are going to see that you will suffer from the transition effect of the adjustment in the exchange rate of the naira.
All right, then. Thank you so much for your time today, Ebenezer. Very interesting insights you've put forward today on the show, talking about the impact of COVID-19 on the banking system and how banks are staying ahead. I've been speaking to Ebenezer Onyeagwu, who's the GMD and CEO of Zenith Bank of Nigeria. And that's it on Beyond Markets for today. Thank you so much for being a part of the show. Remember, you can watch the show at 5 p.m. West Africa time daily and have access to all episodes of Beyond Markets on our website. That's at cnbcafrica.com. Thank you so much for watching and have a wonderful day. I'm Kenneth Igbomor. Have fun.